Welcome everybody to the 40 Finance channel. My name is Jeff Beers, and today I'm sharing with you 5 travel stocks that in my opinion are better plays than the cruise line stocks you see everybody talking about right now. And just a reminder, make sure that you always do your own research and get the advice of a financial professional. I'm just a YouTuber who makes content for entertainment. However, if you do like stock market analysis, investment ideas, and personal finance videos, then make sure you subscribe to the 40 Finance channel. Thank you to everyone for your support so far. All right, so for a little background on this story, about a week or two ago, I made a quick video where I said, do not buy the cruise stocks in 2020. Seen a lot of hype on the cruise stocks on YouTube, you know, the next best way to get rich. And frankly, I just think that there's a lot of risk involved. So I went through my reasons on that particular video of why I would not buy the cruise stocks, and it got a lot of feedback, some of it positive, but there's a lot of folks that are like, you know, that I'm crazy. They're calling me crazy, which may be true. And they had all the reasons, you know, like the stock market's going to go back up, cruise lines will be back in business in 6 months. Most of the people are like, hey, I'm gonna, you know, hold this for 10 years, so I'm easily going to get 200, 400% gains on my money. And, you know, my take at the end of the day is you don't need to get into the risk that the cruise line stocks have right now in order to make money in the market. And I think that that was really, after studying the comments, that was the difference between my perspective and most people. I believe that there's better investments available, and some of those I'll share today if you're super intense on getting in on the travel world apocalypse. The best way to summarize, you know, my difference on what I shared on the last video and what people think, I think I kind of communicated it well on this comment that I shared here. Here we had a user that comes in and says, you know, basically, you heard it here first, cruise industry will be back to normal within 6 months, obviously implying that, you know, this purchasing cruise stocks on their lowest of lows is the best thing that you can do, and it's an immediate return. You know, and my comment to that is, if that is true, if that world becomes reality where cruises are going back to 100% capacity in 6 months, then I absolutely promise you that you need to do absolutely nothing with cruise stocks to make a lot of money in the stock market. I don't believe you need to wallow in a lot of risk right now in order to make a lot of gains in the future. And if cruises are sailing at full capacity in 6 months, then that will hold double true. Okay, so before we jump into the 5 stocks I'm going to highlight, I just call out some criteria here. I did not do a very good job at this on the last cruise video that I did, so I'm trying to get better at those things. Thank you for your patience. Our goal here is to buy low on what I'm calling the travel industry apocalypse, right? So we know cruise stocks is an option to buy low on the travel apocalypse. I'm providing alternatives to doing the exact same thing, okay? We also want to manage our portfolio risk. At least for a guy like me, this is not a high roller channel by any stretch of the imagination. We're trying to get in here. We're trying to make profits. We're trying to build our financial future. Next, we want to aim for the fastest recovery candidates. We don't want to have to wait 3 to 5 years to make our money back if there is other companies that could come back faster and produce not only stock appreciation, but dividends, safer yields, things like that. And then lastly, for all of these, we're going to hold them at least 1 full year to avoid income tax, regular income tax on them, right? So we want to get past 12 months at the absolute bare minimum so that we can defer to capital gains tax. It really comes down to the difference, you know, between a 10% tax on our profits, you know, versus a much higher percentage depending on where you sit in the world. All right, first stock on the board today is what I would consider to be the safest bet if you want to bet on the return of the travel industry. And the safest bet for me would actually be an ETF. It's one I talk about here quite a bit. It's the IYC, iShares Consumer Services ETF. Right now on this stock, we had a high in 2020 of 238 so far. We're down to 165 per share here today. That's a minus 30% from the 2020 high. So that's not that big of a number, minus 30%, right? So a lot of people are like, oh, geez, you know, this nothing compared to what the cruise industry is going through right now, being minus 70, 80%, wherever they're at. And the point is, exactly, right? Exactly. Our entire consumer services world is in utter chaos right now with no known timeline for returning back to normal, right? And yet through all that storm, the IYC is minus 30%. The top 30% players on here, we've got Amazon, Home Depot, McDonald's, Walmart, Costco. So that doesn't sound like it has a lot to do with the travel industry, but if you go farther into the IYC holdings, you have a ton of travel. You have Hilton Hotels, Marriott Hotels, Las Vegas Sands. You got all three of the big cruise line holders. So they're all in there. You have exposure to the travel industry, but this is a market cap weighted ETF, right? So as those losers are falling off the map a little bit, you have less exposure to them. And when they start to gain and go back up the list, you'll have more exposure to them. If Home Depot, for whatever reason, files bankruptcy and starts to lose its market cap, then Home Depot will eventually disappear from the IYC. And if Carnival Cruise Line suddenly becomes some sort of world player, then they will climb up. So this is a great way to get exposure to a significant amount of travel stocks without being knee deep in the weeds of risk, and it auto balances for you basically all the time. So if you're a regular investor and you don't have a lot of time to read the news, it gives you a fantastic opportunity to capitalize when consumer spending returns, and you still get exposure to the cruise stocks. All right, number two on the board, getting away from ETFs, right, which are probably the least risky opportunity. Now we'll get into what is, in my opinion, one of the best pure travel plays that you can get while maintaining a smaller risk exposure. That company is Booking Holdings, ticker symbol BKNG, and Booking Holdings sits right at the top of the travel pyramid in the internet age. They do not own hotels. Okay, they do not own ships. They do not own anything. Really, they are a conduit for booking travel and saving people money on travel. So when the world does come back to normal and people decide to make travel plans and they're booking airplanes and hotels and cruise lines and all these things, Booking Holdings will see their revenue go up. But like everyone else is in the game right now, they are having a tough time with revenue. Booking Holdings had a high of $2,086 earlier this year. They're now minus 41% from that high. Okay, so they're down to $1,233, and even though that sounds like an expensive stock, so to speak, you still have a stock that's 41% off of its highs, and frankly, the way things are going in travel, I would expect it to continue to fall over the next 30 to 45 days unless some really good news comes in much faster than it is to date. So you got a PE right now of 1103. And Booking Holdings has about $9 billion in debt, according to Yahoo Finance. They also have $7 billion in cash. And the best part about having $7 billion in cash with Booking Holdings compared to like a property is that they have some opportunity to lay off employees and really not risk a whole ton of stuff to their future business, right? Their hotels are not getting older because they don't own any. Their ships are not riding at sea because they don't own any. It's costing them revenue every day, but they have a lot more opportunity being an internet company to sort of keep the fort down and wait for the storm to pass, especially with $7 billion in the bank. All right, next on my list, similar to Booking Holdings, but a smaller company, and that is Expedia Group. Expedia Group has really blown up over the past 3 or 4 years as sort of an internet provider. They do the same thing as Booking Holdings. Booking Holdings is a big competitor of theirs. They're just a little smaller from a market cap standpoint. And with Expedia right now, you got a price that is 57% off of its 2020 high. So the 2020 high is $121. Now we're down to 52 here today. And there's a couple great reasons to think about Expedia as a cruise line alternative. Similar to Booking Holdings, whenever travel comes back, they will start to make revenue immediately, right? So I could, I think we all assume that the first things to come back online are going to be hotels first, right? Then airplanes. I'm not sure where cruise ships fall in all this, but they are definitely past the first two things I mentioned. Theme parks, things of that nature. Expedia has exposure in all those areas. They're helping people book vacations across all those different things. As a bonus for investors, obviously the cruise lines are known for their high yield dividends, and Expedia also offers a smaller dividend, but still a dividend at 2.81%. Here today, you got the company as a whole has about $5.5 billion in debt, but they also have $3.84 billion in cash. So for an internet company like Expedia is, and similar to Booking Holdings, they have enough cash. They should be able to weather the storm. They also have the same opportunities to lay off employees without letting things rot away like a hotel or a cruise ship would. All right, now we're going to start to get into some of the riskier plays here. And when I say risky, I just mean where I sit today, there's no cure for the coronavirus, right? And there's no obvious solution to the problem that we're having. All I see is news where we close more things. And that is bad news for companies like Hilton. And this stock hasn't gotten hit as hard as I figured it would have by now, but I do know that Hilton is really closing hotels left and right. From a safety perspective and from the lack of bookings. Like, some of these hotels can have, like a 2% occupancy right now because no one's traveling. And so that's a scary thing because these properties are huge and they have a lot of daily expenses. Now, Hilton's done a good job, I will say, of becoming more of a franchise play for their brand. So they don't own all of their hotels or nearly all of their hotels, but they collect royalties on the names, marketing, things like that. So they do have a little bit of protection, but there are some scary stats, that I noticed, right off the bat. You got a PE of 2027 here today. That number is not even real really anymore because the revenues are going to be so dried up for Q1 into Q2. That's still a little high for some of the things we see so heavily discounted across the stock market. But the other thing that's a little scary with Hilton right now is you got a $9.6 billion in debt, and at least according to Yahoo Finance, they only have a $500 million in cash. So not a lot of cash. I certainly would expect them to be drawing down bigger credit lines, which obviously will inflate the debt even more. But if there's a bright side here, the first thing to come back online, as I mentioned earlier, is probably going to be the hotels. The one thing that's for sure, if you are betting on a travel industry bounce back, then we can feel pretty good that hotels are going to be in the front of that bounce back. And Hilton is certainly in a good position to take advantage of that. They also offer a 1% dividend as of today, so a couple nickels and dimes for you as you go along your journey. When things do turn around, I would expect that Hilton would be expanding that dividend. That could be a few years out though, depending on how far in debt they get through this whole thing. All right, next up, I sort of saved the riskiest one for last, and it's not even super crazy risky, except for the fact, just like the cruise lines, we don't know what's going to happen, right? No one knows what's going to happen, and no one knows how long any of these companies are essentially going to see 0% revenue and how long can they last. And with Las Vegas Sands, it's kind of a double-edged sword, right? Because you have hotels plus casinos. So you need two things to come back online. You need, maybe even three, right? You need travel in general, because nobody lives in Las Vegas, probably stays at these resorts. You need consumer dollars to come in and gamble. And you need consumer dollars to come in and stay the night at Las Vegas Sands. So I feel like that's asking for a lot of things to come back online. But again, if you're bullish on cruise stocks sailing the 7 seas in 6 months, then I guarantee you Las Vegas Sands will be back online making money way before the cruise lines will. Sands right now, you're at 43.57, which is 41% from its 2020 high. You got a P of 12.45 and a decent chunk of cash. You got $4.2 billion in cash. You do have almost $13 billion in debt. The problem with the cash number on something like Las Vegas Sands is it's property holdings, right? And it's physical things that need maintenance and upkeep and all those, not to mention the amount of employees it takes to run one of those gigantic hotels. So it's a good amount of cash, but I could definitely see that it would be burned through quite quickly. Don't be surprised if they're drawing down credit as soon as possible to keep their cash flow still alive. As a bonus for Las Vegas Sands, you do get a 7.83% dividend as of here today. So that's probably the biggest dividend as far as competing with the cruise stocks. And so if it came down to what would be like the riskiest play on my board here today, in my opinion, and you want something that's playing off travel, you want something with a dividend, you want something that's pulled off of its high, I think Vegas Sands goes down, basically every day Vegas is closed, Sands has an opportunity to go down even further, and you may see it get to a -50, -60. I'm not sure, I can't project that, but you're gonna have the opportunity when you feel good about the ship turning around to get a dividend and to be in a good company that will eventually come back online before the cruise stocks will. All right, guys, so those are my 5 stock plays to choose instead of the cruise lines in order to manage your risk and get maximum return on the travel industry apocalypse, as I'm calling it. If you're a newer investor or a small-time investor, the closer these cruise lines go down to 90%, 95% on their former price, the higher the risk goes up. And for some people, that's okay. But from my standpoint, you can do just as well in the stock market and perhaps get your money back even faster by looking at some of these opportunities if you're hell-bent on betting on the travel apocalypse. That's the other thing. For my 2 cents, I'm looking way more into tech and all those things for the biggest, fastest bounce back that I can find. But if you believe in cruise stocks, then you're saying to yourself, I believe that the 90% drop is overinflated. I think that travel comes back in 6, 12, 18 months. And if you're saying those things, then my counterpoint is that there is other opportunities to make your money back faster. And so that's the difference. I'm not saying cruise stocks are the worst thing to invest in. I'm just saying, in my opinion, your risk is going up. There's other opportunities. The riskier it gets, the more opportunities there are to look elsewhere for a quick bounce back. Hope you guys enjoyed this video. Really appreciate your support so far. Please give me a like and subscribe, especially if you like stock market analysis. I'll see you on the next video.